Well, here's a graph of the Aussie dollar last night, and guess which events mattered the most? And there are no prizes. At 10:30 p.m. our time, US inflation in May was revealed to be 0 for the month and 3.3% for the year, less than expected. So the US dollar fell and the Aussie dollar therefore rose against it. At 4 a.m, the Federal Reserve left rates on hold as expected, but changed their mind about how many rate cuts there will be this year, from 3 down to 1. So the US dollar went up and the Aussie fell. At 11:30 a.m. came the data on Australian employment in May. Ho-hum, said the markets, looking at their watch. So let's compare the key economic data for the US and Australia. Inflation, 3.3% and 3.6%. Unemployment, 4% each. Central bank policy rates, 5.5% in the US, 4.35% here. So why is it more than 1% lower here, even though our inflation is higher? Because they've got 30-year fixed-rate mortgages and we don't. So rate hikes here hurt more. The Federal Reserve now expects its policy rate won't be the same as ours until the middle of next year, unless the Reserve Bank cuts first, of course. A lot will depend on Australian employment, and so far job creation is keeping pace with the surge in migration. So the employment to population ratio basically hasn't changed for about 12 months, and that's very unusual. Australian dollar is now 66.5 US cents. The local share market rose 0.5% as rising banks and retailers offset falls among resources stocks, even though most commodity prices went up, apart from oil. And finally, the New York market rose last night, but shares fell in Tokyo and Shanghai today. And that's finance.